Let's also talk about the banking major ICICI Bank, because definitely a great set of numbers is what we have seen from the bank in Q4, definitely surpassing the street estimates. And what we have seen is that even in the call, the management commentary has been quite convincing. The company did showcase a healthy balance sheet growth, as well as the asset quality has seen an improvement. And the ICICI Bank is one of the gold standard in the banking space and will continue to see an expansion in the multiple. That's the call coming in from Anindya Banerjee, and all these brokerages have definitely given a thumbs up. As we see that the stock was very near to its all-time high levels, and the street was actually building in a great set of numbers coming in. So on the back of that, ICICI Bank did had a gap up start, but now trading almost flat, but nevertheless not very far from its all-time high levels. If we talk about some of the other internals, then the asset quality continues to improve. The retail delinquencies have peaked out, is what these analysts are highlighting, and there has been better NIMs and easing liquidity cycle, and they expect the fees to grow in line with the assets. That's also the call coming in from Anindya Banerjee. So that's about ICICI Bank. The stock is trading flat as we speak right now.
All right, moving on then, we also had the ICICI Bank con-call highlights. Let's go cross and take a look at that.
As far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness, given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. So we had to be, I think, a little more, I would say, disciplined in terms of the spreads, etc., that we were charging over the benchmark. But other than that, no specific caution. So there was no one-off in the yield on advances. I think probably the largest component driving up the yield was what we had spoken of, in I think Q2 and Q3 last year, which is the benefit of the day count. Margin number to focus on in our mind is really the 4.3% for the full year. That would be a more representative number.